All right, guys, sometimes I feel like my life is not real. I had the crazy opportunity to speak to Tom Wheelwright's Inner Circle franchise group. Tom Wheelwright, if you don't know, is probably one of the most famous CPAs. He's Robert Kiyosaki's CPA. He wrote one of the top books out there in taxes called Tax-Free Wealth, and he's someone that I've been following for multiple years. Recently, I got connected with him. I actually spoke on the same stage he spoke on. It was terrifying because he spoke, did an amazing job, and then I spoke right after him, and he's in the back of the room, and I'm talking about life insurance and talking about taxation of life insurance. And, I give a ton of talks. I'm confident of what I say, but it's always a little bit nerve-wracking to know, like, someone that you look up to is in the back of the room and you're like wondering what their take is. Well, anyways, at the end, he's just like, Caleb, the way that you talked about life insurance is awesome. Like, I appreciate all the things that you said. I thought you made some really good points, and we got a friendship, which I'm blown away from. And then you've seen, I've had him on the show a couple times. Well, he has an annual event, and he had like a pre-day before his big annual event, and he has his top franchisees that come in one room and they brainstorm, and it's a really, really cool one day. And I had the opportunity to go there and speak about life insurance. Now, anytime I have the opportunity to speak, I can give talks or do fireside chats. And he asked me what I would prefer. And I was like, Tom, it would be amazing for you to be doing this with me and hear your perspective. And his perspective's a little bit different than mine, but I would way more prefer that than giving some type of canned presentation. And so what you're going to see is parts of my time with everybody in person, and it was a blast. And if you're watching this and you're like, I would love to talk with your team personally about, does life insurance make sense for me, or should I review my life insurance policy that I have, we will have links for you to connect with our team. One other thing that I wanted to say before we jump in is the video quality at times isn't the greatest. The way that this was filmed was something that maybe I would have changed if I could do it over again, but at least we have some of the content. The audio is good, so you'll be able to see that. But I just want to give disclaimer, it's not the highest definition of the content that I've ever shot in my life, but the quality is all that matters. So without further ado, enjoy.
Let's talk about reasons that you might
Yes.
Use life insurance. Octavio, what would be a reason you would want life insurance?
To protect my
Okay, protect your family. Now we're term. Okay. What's a reason you might want a whole life policy? Maria?
To be my own bank, to borrow against the...
Okay, so one is to be your own bank, and he's going to go all into that. Boy, here you go. This book, this book, this book. Right. There's literally 1,000 books now on it. The originator really was
Nelson Nash.
Nelson Nash.
The infinite banking concept.
He's the guy. Okay.
Rest in peace.
I call him he's the tax-free wealth guy of the insurance industry. I'm just kidding.
Yes.
But he like started the industry, really. He started the whole concept of be your own bank. And so be your own bank just means, well, I'm going to have this policy that does this work for me.
Yes.
And is available to me. Now, what I like about it from that standpoint is that it's available, but I don't have to take it. To me, it's a lot like having a HELOC, right? So I recently refinanced my house because I figured we were at the top of the market. Okay, I was pretty sure we were at the top of the market, and it's coming down, and we are starting to see it come down. I want my HELOC as big as I can get it. Am I ever going to use that HELOC? Well, Luann would say, I hope not.
Yeah, that's a really good
right? I probably would not, because I don't want to. I don't want to. If I found, okay, I've just got this incredible investment opportunity, I need this money. I mean, for example, if I all of a sudden decided I'm going to not just have, we're just not going to just build a franchise, I'm going to go out and build a firm, okay? Well, that's when I would use a HELOC, because guess what? The chance of me losing money buying a CPA firm is like zero. I'm not going to lose money buying a CPA firm. I know how to hire Karen to run a CPA firm. I know how to do that, okay? I can't say I know how to run a CPA firm, but Karen does. And I know how to find people who actually can do that, right? So I'm not concerned. If I had an investment opportunity that I absolutely go, hey, I'm not going to lose money at this. I'm not going to go take my money and put it into a real estate investment that I'm not, especially not like a syndication, because I have no control over that. There's no way I would use a HELOC for that. And I hear people talking about that all the time and going, whoa, that is like a really risky idea, because now you've got that obligation. That is absolutely, you have to repay that. Now, life insurance is a little different, because you are borrowing. Now, who are you borrowing from?
Yourself.
No, you are not.
The insurance company.
You are borrowing from the insurance company. This is a very important point.
Yes, it is.
Because if you're borrowing from your 401k, you are borrowing from yourself. But if you borrow from an insurance company, if you borrow against your whole life policy, you are borrowing from the insurance company. Which means if you use that money for a tax-effective investment, that interest is deductible, because you're borrowing from the insurance company. Okay, you're just using your life insurance as collateral. That's all you're doing. You're just using it as collateral. It'd be no different than if you borrowed from a bank and used a CD as collateral, which banks require these days, right? You can't borrow unless you have money. You go, well, why am I borrowing? But so there are times when when I look at that, banking yourself, I'm going, I want that availability, and it's a guaranteed availability,
That's
right?
correct.
So whatever my balance is, my cash surrender value is, I absolutely under the contract can borrow
Yes.
that money.
And what I will add to what you're saying is you talk about pension, like we want to have a long-term mentality. The beautiful thing is with pensions, you don't have as much flexibility. You don't have the ability to potentially use that capital.
Right.
The beautiful thing about being your own bank, or the ability to borrow against your capital, is it gives you optionality, gives you that HELOC functionality from a standpoint that I can use my capital or the insurance company's capital and use my money as collateral guaranteed. So it allows me to be more long-term,
Right.
because I don't have to say see ya for the next 30, 40 years. That's the and component of not everyone, we'll talk about it later, not everyone should be using their policies. A lot of people are using their policies and getting worse off because of what they're doing
Right.
with that. But the fact that it gives you that ability allows you to be more long-term. And that for me was like an epiphany in itself, where you're telling me I get all the benefits of insurance, but I don't have to wait till I die. It's the idea of live your life. You can live your life insurance, and it's not just the thing that you have to wait for when you die.
Well, and here's another way I look at it. And this is actually how I use life insurance for me, is that if I have this over here, my life insurance, then my other assets, I can do whatever I want, because I've got this safety valve right here. It's, again, why I like a HELOC. That's a safety valve, okay? I have a safety valve, which means that if all my assets go down over here, or I invest poorly or whatever, something happens over here, I've still got this life insurance that's available to me. Okay, it's protected. It's good. Asset protection wise, it's protected. And so for me, the way I use it is, I want enough insurance so that my family doesn't have debt when I die. That's it. I don't need them to have money. Now I've got one son that I need him to have money, but I don't need my family to. I mean, Luann isn't looking for money when I die. She's got her own assets and all that kind of stuff, right? So that's not her issue. What she doesn't want to do is have debt. She don't want me to put her into debt and have that risk. That's a big concern. And so the life insurance provides that liquidity, so that when I die, there's no obligations that can't be met, even if it's property taxes, for example. Not just the actual loans, but the actual, okay, until I can sell this. What I don't want to do is, you don't want to put your family into a situation where they have to have a fire sale of your assets. You want to give them time. You want to give them liquidity. And so to me, that's what it is. So it means all my other assets, I can do whatever I want while I'm alive. I've got this over here to take care of those things that are kind of a contingency. So what's another reason for life insurance? There was somebody over here.
I think she said it. I just said investments, that's all.
Okay, investments. What's another reason you might want life insurance? Okay, you guys all have businesses. What's a reason for it in a business? Shalita?
I wanted to piggyback off of Maria's part when she was saying being your own bank.
Yeah.
I've heard too, like, technically you don't have to pay back the loans. Is that true, or is that?
That's technically true. Yeah. It's what is it? Borrow. What is it?
Buy, borrow, die.
Buy, borrow, die.
Okay, so just like 10,000.
But you have to pay the interest.
You don't have to do anything. You don't even have to pay the interest. The interest will compound, and so you have to make sure that you're not over leveraged, because there could be a world where if you took a max loan and then the interest is compounding, that you could get potentially a little bit in trouble. But overall, the insurance company is the only institution that can allow you to take a guaranteed loan and you don't have to repay it, because they have your death is a liability on their balance sheet. So ultimately, if you die with an outstanding loan balance, your beneficiaries or trust or whoever's getting the money is going to get the death benefit minus the outstanding loan. So but just to be really clear on recorded, that I would never tell you not to. You should at least pay your interest back, or at least that should be the goal. I would not want to create a message that's like, never pay it back, because you could potentially be enabling bad behavior. But there's some cases where if you have an investment or something that's earning a greater return, why would you want to sell a greater return asset to pay something off? Right. So there's a lot of cases where people will intentionally choose, because of opportunity cost, to have their outstanding debt potentially compound because their assets over here are growing. But in anything, you have to factor in risk, and that's what entrepreneurs do typically a poor job of, is in understanding the real risk-adjusted.
Hey, it's Caleb Guilliams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it, and if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary-style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
So I have a question for you.
Yes.
So one of the uses I hear from the insurance industry is retirement.
Yes.
Walk us through that one.
Yes. What is retirement? What I call it is just future cash flow. We want to plan in such a way that we'll have a future cash flow stream to come in whether we're working or not. And so life insurance is a permanent asset that's not just has some of the best tax benefits, but also my death is going to happen. Like, it's going to happen. And so if you know something is going to happen and you have something that's ultimately leveraged around that, it gives you options. And so one of the things that when I wrote this book, I could care less about retirement or anything in the future. I was more obsessed about the banking aspect. And then the more I learn about it, is there are lots of wealthy people that just use life insurance as a part of their portfolio that allows them to get more cash flow in the future. So there's a couple ways that they can do this. If you have permanent life insurance, any type of pension, any type of Social Security, any type of annuity, there's different payouts that they can pay. There's single payouts and joint payout. Most everyone chooses the joint payout. That's essentially, I'm going to take less money, but if something happens to me, my partner or spouse will be able to get a stream of income. That is a form of life insurance, believe it or not. It's just a crappy form of life insurance because they're almost bundling everyone in there, and you're getting like the worst health in that. If you do the single payout, you get a lot more money up front, but here's the problem. If you die, your spouse gets nothing. So what if I had a death benefit that was millions of dollars, that if and when I die, my spouse gets that death benefit so I get more money today, and my life is covered. This is called the covered asset strategy. My life is covered, or gives me the permission to spend more money from pensions, annuities, other assets, knowing that if and when I pass away, my partner, my spouse, will actually get my death benefit, allowing me to spend more money. Does that make sense?
It's basically what I was explaining. That's how I use life insurance. Is I want to be able to spend more money.
Yes.
So that I don't have to worry about.
One of my good friends, his name is Tom Wall. He's a PhD in retirement income, which sounds pretty lame, but it's like he's like an academic. And his book is called Permission to Spend, which is not a new concept. It's been around for years. He was just smart enough to write a book around it. But his whole concept is, he doesn't talk about life insurance from banking or estate planning. It's all just having life insurance. He in his words, he would call it a better bond. Because if you look at what the benefits of bonds and you look at the benefits of insurance, insurance gives you bond-like returns in potentially a tax-favored way, protection elements, but also gives you more options, in his opinion, on income.
I get that side of it, but what about, so there are some life insurance professionals who would say, but this actually, you can just take a stream of income.
Yes.
So how would you do that?
Yes. Okay. So the second part is you could just take a stream of income from your insurance policies. And in a lot of cases, what they're doing is they're withdrawing their money up into a basis, and then they're taking a loan for the difference. And that income is just coming in tax-free cash flow, because it's either it's money that you've already put in.
Okay, so this is not something that I'm an expert in from a tax standpoint. So you're saying that when you pull the money out, it's basis first, and it's not proportionate.
Yes.
It's basis first in life insurance.
Yes.
So if I'd put in $1 million,
you can take out $1 million.
I can take $1 million out tax-free, so it's more like a Roth.
Yes.
Because the Roth's the same way, right? Within that first 5 years, I can take out the money I put in, and then it's only if I took out the income that it would be taxable on the Roth in that first 5 years.
So that's life insurance could be used as a supplement.
Okay. Keep going.
Okay, another strategy that can be used with life insurance is what's called a volatility buffer. Whereas if you have money invested in the market or in other assets, the worst time, especially in retirement, selling at a loss can be a really bad thing. And so if you have an asset, whether it's a HELOC, whether it's an insurance policy, whether it's a savings account, if you have an asset that's not correlated to the market that allows you to tap into that and let your assets recover, if you have anywhere from 4 to 8 years of volatility buffer, what the retirement experts will say is you could, in many cases, almost double your safe withdrawal rate just so you don't have to.
But if you're taking the money out, is that a loan that you're taking out?
Yeah, you could take a loan or withdrawal base. It depends on.
You can withdraw your basis. I get that.
Or take a loan. The point is that you're not selling assets that are down. You're letting the assets recover.
I get that, but I guess what I'm getting at is that you can actually withdraw the basis if you want to withdraw.
If you want to, yes.
Or you could leave the basis in, because the reality is your assets inside your cash surrender value is still growing.
Correct.
Typically around the same amount.
Yeah, I would say
percentage is your loan.
Probably 1% less, but yes.
Right, but
in
very
some
close.
Cases
So
more.
the spread's not that big.
Yes, correct.
The spread's not that big. You understand what I'm saying? So the spread between the interest rate you're paying and the interest rate they're paying is typically around 1%.
Very close.
It's not very much.
Yep.
Okay, so what that means is that if you borrow, your borrowing cost is really 1%. It's not 5%.
Yep.
Your interest rate may be 5%, but then you're not paying that back,
correct.
Right?
The idea is to have the death benefit paid off.
Got it.
And just, again, everyone's in a different situation. I would choose to borrow in the future versus withdrawal, because if you withdraw, you can't put that money back in.
Right.
Borrowing, again, I like optionality and more options. So I
like that too.
I like more options, because who knows what's going to happen. And if I get money somewhere, first world problem, where am I going to put it? I could repay back my policy loans, and that's a pretty amazing place to get dollar for dollar liquidity and get all the benefits of insurance.
So go ahead.
So when you pull, like Tom was saying, like withdraw money out, does that impact your death benefit, like the
Yes.
face value?
Yes.
of-
It does.
Well,
Same thing with
yeah,
loans, by the way.
but here's another thing that I'll let you explain,
Okay.
but I'll give the basics of it. And that is that as you pay a premium, okay, your face value is actually typically going up.
Correct.
Well,
So
explain
So
that.
one of the common things that you'll see like Dave Ramsey
Why?
talk about is they'll say, if you do permanent life insurance, when you die, they steal your cash value because your death benefit stays level. And so his whole deal is you've paid 30 years, your cash value is over here, but your death benefit, you're still getting the same, and so all your cash value is stolen. The way that most insurance policies, especially whole life that's with the good companies, every time you fund anytime you fund life insurance, the death benefit is increasing. It's increasing more than what you're putting in.
Right.
And so that whole concept of your level death benefit, if you have a level death benefit, you're probably not in a great product. And so that's so easy to push back on because you just show an illustration. And if I put in $1 million into a life insurance policy, my initial death benefit and where my death benefit will be 30 years from now is going to be far greater than $1 million.
Yeah, so for example, so with my policy, I'm at the point now where I have more cash surrender value than the dollars I put in. So if I put in $1, I have $1.10
Yes.
of more cash surrender value by the dollar I put in.
Yes.
But I also have a higher death benefit.
Yep.
So I'm getting a higher cash surrender value and I'm getting a higher death benefit. So I'm getting both. Well, what that means is my death benefit's going up and I take out that cash surrender value, well then the net may still be my original, right? You can plan that out. One of the people in the life insurance industry, I think has actually done a lot for the industry is Todd Langford.
Todd's incredible.
Todd is the nerd to Kim Butler. So Todd's Kim's wife, Kim's husband, sorry. And Todd is the nerdy guy in that relationship.
Yep.
Kim is not at all nerdy. But what Todd's done is create all these tools
Yep.
for the insurance industry. And so I highly recommend if you're going to work with an insurance professional, make sure you work with somebody who uses Todd's tools. They're really massive spreadsheets is what they are. I wish, I know they've talked about it, but I wish they turn them into software because they're not software still yet. And it would be so much better if they were software. But they're basically massive spreadsheets. But what some of them allow you to do is actually project this out.
Yep.
What's his last name, Tom?
Langford.
And what I'll do is I'll give you all the resources. I've probably done 25 hours of content with Todd on our channels and all. So there's some really good content that we've done together. And what I can do is prepare
You'll
a
love
couple-
him. He's such
Yeah.
a nerd.
Yeah, he
is
speaks your
such a
guys'
nerd.
language.
I can't follow him. I am not nerdy enough to follow Todd.
There's really there's a lot of benefits, but there's 3 big categories when you fund life insurance. There's protection, and not just protection of your family, but also protecting your dollars.
Right.
I mean, Enron executives are still getting payouts from their annuities and life insurance. They've committed fraud, but in the state of Texas with so there's benefits to protection.
So if you're
element.
planning on committing fraud, it's a really good idea.
Good trust and good insurance. So protection. Then there's the use element, which is the ability to utilize your capital throughout your life. I can't tell you how valuable this is. I can use capital and not hurt the protection or the future benefit that I'm going to get. And then the last, whether you call it retirement, I'll call it future cash flow. And so there's a lot of other benefits in my book. I have over 17 that I list out. But the 3 big categories are, when I put money into a life insurance policy, I'm protecting my dollars and my family, and it's growing every year. I'm also not giving up the use of my money throughout my life, which you could say is one of your greatest financial needs, is using capital. And I'm also creating a better benefit for the future. And so if I'm working with someone who's not an entrepreneur, I'm focusing on protection and retirement. If I'm talking to someone who's an entrepreneur, I'm bringing in the fact that they can use their capital, protect their family, and have an amazing pension-like asset in the future. And so there's other things like, could you save more money if you have access to it? You could argue yes. There's other things, but these are like the 3 core areas that I would hone in on, and then within that, there's a lot of different
Right,
subcategories.
and protection includes buy-sell agreements.
Yes.
That's a protection
for
element.
sure.
Right, so that's one where we should use it all. I mean, you have a partner, you need a buy-sell agreement, and you probably need life insurance to effectively manage that buy-sell agreement, because what if somebody dies?
Yep.
Right? So that's where that buy-sell agreement makes, so, yes.
Do you mean so that if your partner dies, that you can buy it from their estate? Is that what you mean?
No, so, yes, well, so, right, so you don't want to be partners with their spouse or their descendants, right? So in the buy-sell agreement, how are you going to get paid out?
Yeah.
Because you're not paying.
If Tom and I are partners and he passes away, we have insurance. That insurance pays me to the ability
Right.
to pay.
So that he can pay for
Yes.
my interest.
Yes.
Thank you.
Yep.
Okay, and I think that's something that's really important. But by the way, we had a Supreme Court case last year. I can't remember the name of it. Do you?
No.
Where you have to be very careful about those life insurance, because you don't want the life insurance included in the estate, along with the value of the business. And the case in 2024.
I'll look it up.
Look it up.
And have a.
Just get Perplexity going. You got it. It's the reason I use this.
Yeah.
The best computer ever,
for
especially with
sure.
AI. But having those buy-sell agreements, really important. Really important. You guys should have buy-sell agreement going on, right? With life insurance, because you want to protect.
Because otherwise, you're how else are you gonna? It'd be so inefficient to not have insurance do it, because then you have to put money.
Well,
to the
yeah,
side.
but and the other thing is, let's say Brian dies, you may be fine having them be an owner, but they want the money, right? They may need the money for whatever reason, and they don't want to get money over 5 years, which may be the way it's set up, right? Otherwise, in a buy-sell, right, where when I retire, I'm going to get paid out of 5 years. That's the standard. But instead, with life insurance, you can do a true buy-sell. And I think that's a really good reason. The other reason is you might have life insurance just from a liquidity standpoint. So that's one I didn't see on there, from a liquidity of your
the use, and I guess the use and liquidity.
So I think about liquidity from an estate standpoint.
Okay.
Historically, back when we had an estate tax exclusion of $600,000.
Wow. Jeez.
Can you imagine? We did. We used life insurance. We used ILITs, irrevocable life insurance trust, all the time, because we knew we were going to have estate tax. We needed the life insurance to pay the estate tax, so we didn't have to have a fire sale. If you haven't done the estate plan, get it out. Shame on you. But if you haven't, okay, you'd better have at least life insurance in an ILIT that's outside of your estate, so that you can pay those estate taxes.